Hello, my friends. Brett Pattison coming at you from the financial capital of the West, the land bountiful. Joined by the chairman, who's also in the land bountiful, Brian.
We're not too far apart. How you doing,
No,
Brett? Yeah. Good
we're
to see
not
you.
far apart at all,
Yeah,
brother.
good to see you.
Yeah, good to see you as well. And from down south, the land of Saratoga, with an extra polished, shiny scalp today.
Thanks
Looking
for
sharp as
noticing.
a tack.
Appreciate you noticing that.
Coconut oil.
I've got a little separation anxiety here, guys. I mean, because you're all the way up there in the land bountiful. I'm down here in Utah County.
Well, we feel it too. We feel
Yeah.
that same
Sure.
separation.
Yes,
Yeah.
we do. Absolutely. Good to see you, Mike.
You as
Great to
well.
see you. What a week. It's a beautiful week. Spring is springing finally, and the market is on fire right now,
Wow.
which you wouldn't know if you just turned on the regular news. But we're gonna talk about that. In fact, this is what we're gonna do today. Do a market recap. Where are we sitting? Talk about the big news of the week as far as the market goes. We're going to dig into a little bit of the biggest companies in the world, and then we want to do the big takeaway for everybody, which is talking about diversification today. So first off, here's how the market looks this year. It is Friday. It's actually May 1st. Friday, May 1st, year of our Lord 2026. The NASDAQ year to date up 9.76%. That's bananas.
Is that right? 9%?
9.76.
That's
It's
surprising.
killing the S&P, which is up 5.91%, my friends.
Wow.
Isn't that fun? Hey, check. So on March 30th, a month ago, that's when the market bottomed. Since then, the market was down. I think NASDAQ was down about 11%, S&P down close to 10. Since that point, the NASDAQ's up 20.78%. And the S&P's up 14.28.
I wonder
That's
how that compares historically. Like that's an epic run.
It's an epic
Yeah.
run. And we always say, right, as fast as the correction or bear market occurs, the subsequent bullish move is just as fast. I feel like it might have been a little faster this time. I mean,
I think it was.
we peaked in October, November, that time frame, and we're at all-time highs today, which is crazy. Here's a crazy one for you. If by chance you had kind of a disciplined approach to investing, and let's say you bought long calls on March 30th because that's the disciplined approach.
This is hypothetical, right?
Hypothetical, of course. Your long calls on the Qs, the NASDAQ, up 84%. And your long calls on the S&P up 68%. Hypothetically, of course, Brian.
Yeah.
Yes. That's crazy.
That is.
You guys,
It's a plan.
I love
You've got
investing.
a plan, right? I mean, you're talking about a plan. Certain
Stay
things
disciplined to
happen.
the process,
Yeah.
right? And look, it cuts both ways. If you're wrong, cuts that way too.
Yes, it
So
does.
it's not without risk. But I love investing. I love it. In fact, let's talk about 27% of the S&P market cap came out with earnings this week, and a significant portion of our portfolio. Google, Amazon, Meta, also known as Facebook. I hate that name, Meta. Let's get Facebook back. Microsoft and Apple all came out with earnings this week. The good, according to the market, right? The reaction, meaning when they reported earnings, the good stocks, they jumped higher. Google, Amazon, and Apple, all really good market reaction. Microsoft was kind of, just kind of
That was the good, bad, and the ugly. I think that was
good. Yeah, that was
I
the
think
bad, maybe.
that was bad, and I think
Yeah.
Meta was ugly.
Meta was ugly. Yeah, the good, the bad, the ugly. I like that. Meta was ugly. But okay, so let's break this down. Of these companies, Brian, what stood out to you from the good? Let's start with the good, and then we're going to go ugly. What stood out with you with good? Meaning Google, Amazon, Microsoft.
I think what stood out to me is, which is also, I think, what the same. You could actually flip the coin, and you can see a lot. There are a lot of people are concerned about the capex spend, and but on the other hand, what stood out to me is the enthusiasm from the CEOs of these companies in their capex spend, and you can see it in the reacceleration for these are big companies. You can see it in their revenue numbers. You look at Meta. I mean, it's a ginormous company, and their revenue has reaccelerated up to close to over 30%. You know, it wasn't too long ago that they're sub 20%. You're seeing Amazon a reacceleration in their businesses. You're seeing that. You're seeing it even in Apple. I mean, Apple had really strong numbers, top line growth. So, which is, if you look at Apple's top line and bottom line growth the last few years, it hasn't been that impressive. And but recently it's reaccelerated too. So it's really just the enthusiasm and the confidence of these guys and what they're doing and the outlook going forward. That really stood out to me.
I mean, you have Google, which is a $2.2 trillion company. You have
it's 4.8.
4.8. I doubled it. It's 4.8.
Alphabet, Brett. It's Alphabet. And yes, I struggle with that, just like Meta. Did you know that Google is number 2 market cap company on the street?
And it grew, what was its growth?
A lot. Sorry, I interrupted
you. How much did it grow?
A lot.
I guess that's the point, is you have the biggest companies in the world growing at 28%, 33%, 22% year over year for Google.
Google was 22. You're talking about revenue?
Yeah.
Yeah. It's a lot of additional sales.
How? So is the law of large numbers just a bunch of crap?
Well,
these companies are growing like crazy, and they're already enormous.
There's something unique about these businesses. I mean, they all have scalability, which is somewhat unique. Some businesses, I think, there's no doubt the law of large numbers is something to look at, and I think it applies to these businesses. And it does get more difficult the larger you are to grow at these high rates. But these businesses can scale, and we've seen that. I mean, they are ginormous. In fact, Google, they're on a run rate of $500 billion in revenue this year. They'll be like $450 billion in revenue in 2026. That's insane. That's crazy.
That's insane. I think it's fair to say they have a competitive advantage or competitive edge, right?
And everybody wrote off Google 2-3 years ago. I mean, everybody had written them off.
Yep. Yeah, because their search was going to be damaged by AI.
Yeah. You know what? Their search grew at 19% this last quarter. It reaccelerated.
All right. So here's what Andy Jassy says. All right. Speaking of what you just mentioned, Brian, Andy Jassy in his shareholder letter, which is a phenomenal read if you're a shareholder of Amazon.
Amazing.
Brian and I were geeking out one morning reading it. And this is what Jassy said, one sentence. He said, "It's hard to overstate my optimism for what's ahead." He's spending $200 billion in CapEx.
He said,
for a good reason.
Yeah. And he said, in that same letter, he said, "We're not spending $200 billion on a hunch." He says, I mean, just like, hey, we think this is he has a lot of confidence that these are good investments and they're going to get a good return. And I think you're already seeing that in the revenue reacceleration of all these companies.
Yeah. Yeah. I mean, certainly a lot of good. Mike, what stood out to you as far as the good?
Everything that you're mentioning. And Brian hit this for a second, but it does surprise me that the operating margins of all these companies. I mean, they're going, except for Meta, that is, they've got some overhang from Their reality labs, that's costing them some money. Kind of
Uh,
interesting. But just operating margins up 2% for Alphabet, up 1.3%. Microsoft up 1.4% for Amazon. Apple, up just shy of 1%. So, I mean, these
with that
transitions,
spend,
yeah, and
margins are
all
increasing.
that stuff that's
Yeah.
taking place, and they're
Yeah.
still running efficiently, right? They're profiting from this stuff. It's wild. Here, I got some statistics that kind of blew my mind
Yeah.
out of
Shoot
this
'em.
earnings.
Let's do it.
So those five companies that we mentioned, this isn't even including Nvidia, but these five companies now are $16 trillion, 27% of the entire market cap of the S&P 500.
Okay.
And to put it into perspective, Brett and
Yes.
Brian, if you took the market cap of these five companies and formed a country out of that, right? So you got the valuation, 16 trillion out of these five companies, right? That country would beat the entire GDP of all the countries in the entire world if you take out China and the United States. In other words, these five companies now are just huge, right? To put that
That's a good way.
into
Just
some
huge.
other
I like it.
context, it's just wild.
It is wild. It is wild. So, what stood out to me, and I'm going to take us back in time to a podcast that we did, I don't know, 2, 3 months ago, when the market was kind of, some of these stocks were getting hammered pretty good. Okay. We talked about, and Jensen Huang of NVIDIA has talked about this as well, and that is the AI stack, right? The AI cake with the layers. And then at the top is the applications, which we're avoiding. Anyway, if you haven't listened to that podcast, listen to it. And we said what we love about these hyperscalers, which are Google, Amazon, Microsoft, is that the cloud. Like you have to have the cloud in order for AI to work. The data's got to go somewhere, right? So here's an interesting statistic for what we learned this week. Market share, and I'm going to start with market share. Amazon AWS currently owns 28% of the market share for all cloud, 21% Microsoft, 14% Google. That's where they stand right now. Okay. So the behemoth is AWS and Amazon, and Andy Jassy, who's optimistic as can be. Their cloud growth, 28% year over year. Like we're starting to see that happen. Google Cloud, which is the smallest of the three, 63% cloud growth year over year. In Azure, Microsoft, 38% growth in cloud. So I don't know, what do you guys think? As AI increases in its usage, which it's going to, right? What happens to the cloud?
So I think another thing that I heard, an analogy I heard this just in the last few days, and talking about these big hyperscalers. We're probably in the baseball analogy. We always love using baseball analogy in investing. There's a lot of similarities, but we're probably in the first, or probably in the second inning, probably in the,
Yeah.
it's still early days, believe it or not. In fact, in Andy Jassy's letter, I'll just read this quick quote. He says, AWS is at 142 billion revenue run rate. And he says, yet 85% of global IT spend, 85% of global IT spend remains on premise, meaning it's on company
On site.
on site. It's not in the cloud. It's not at AWS or these hyperscalers. 85%. He says that will change. We're still early stages on this, on AI and cloud. I think
Yeah.
that's
Yeah.
amazing. Yeah.
I mean, okay. So that's the good.
Yeah.
Microsoft, let's kind of not that we don't like Microsoft, we do, but let's put it on the shelf for now and talk about the ugly. Meta. The reaction to Meta was like, oh, it was terrible. Why?
Well, it's really the same discussion. It's just the other side of the coin. I think the reason why Meta, the stock, reacted negatively is Meta upped their CapEx spend from last quarter, and people, investors are concerned on them getting a return on their CapEx spend. And Meta continues to invest aggressively. And I think
So,
I think investors are just concerned about that.
so they raised it. They raised it from 120 their capex to be between 125 and 145 billion, 145 billion. People look at that, and Mike, you said something earlier. You said margins kind of shrank a little bit at Meta, which people don't like to see. So, like, okay, they're spending more money. Zuck has done this in the past. Reality Labs, which you mentioned, Mike. Any concern with the direction of the Zuck and Facebook?
That's a really good question. I think they're a smart investor. They'd always consider the downsides. They would always, think of what could go wrong, think of the concerns. But it is interesting that the pivot's been made away from that reality space. And it is, in my mind, it makes me wonder, that is a drag on them. But it's a negative now, and it will be for a while. I think it cost them like $4 billion in losses last quarter. But you remember how, there was a lot of uncertainty in the past around Apple and their subscription services outside of selling hardware, basically.
Yeah.
And how well those products would grow. And now it's just like it gives them tailwinds now, Apple. I do wonder if at some point in the future, right, let's say the reality glasses that are kind of part of the VR reality space that Meta was trying to build, maybe in the future that business does start to accelerate. Maybe something catches on, and in the future it does well. So I do wonder about maybe in the future that could become a positive. But really, the market knows, right? They understand that virtual reality didn't work, and now they're looking at the super intelligence rebuild. And just like you said, I think, Brian, that Zuckerberg has got such a great track record for making the pivot and turning that pivot into a success. So if you believe in Zuckerberg, right, their pivot into the super intelligence, right, is that going to pay off for him? Well, if you believe in Zuckerberg, you might say yes.
Brian, you've been running around the office as we've talking about Meta. Maybe not running, maybe just walking. But you said Zuck, he fails fast. What do you mean by that?
Yeah, I think, yeah. I mean, he hasn't been 100. He doesn't bat 100%. I mean, he's had failures. He's made mistakes. But once he realizes that he's made a mistake, that's when he pivots. And you've seen that at Amazon. You've seen that at Apple. In the case of Amazon, they've tried all kinds of projects and new ideas, and after a while, they're like, okay, that didn't work. I mean, Amazon tried to build a competitor to the iPhone. That didn't work. And so they pivoted, they moved on, but they fail quickly. You need CEOs, you need leaders of companies to be bold. They invest into opportunities, and when those opportunities turn out to not work out, then you change lanes. And I think being safe as an investor, in fact, I heard Jeff Bezos says that investors often overestimate risk and underestimate opportunity.
Yeah.
And I think you want a CEO that takes risk and calculated risks. And Zuckerberg has done that, and he hasn't batted 100%. But once he figures out that whatever, this isn't working, he's gonna pivot and change lanes. And his track record is incredible. I mean, look at the value he's created for owners of Meta, the last 20 years.
I feel like, completely agree. I feel like, remember last quarter, Amazon came out with their CapEx, which they did not change this time, but they came out with 200 billion. And the market looked at that, and Amazon sank like a rock. The stock, I can't believe Andy Jassy's spending that much money. Completely different this quarter, right? When we see the AWS growth and the revenues. And I feel like Meta is where Amazon was last quarter. People are afraid of the CapEx spend. Now, of course, they don't have the cloud, but if you have faith in Zuck, which we do, look, I mean, he's out there doing jujitsu and eating meat, He's
Well,
on it.
if you think about Meta, I mean, that's the platform that draws all the attention, right? Talking about
Yeah.
Facebook and Instagram, they've
Yep.
got the clear advantage, it seems like, in that space. And that's a, you know, that's a hugely valuable space.
Huge competitive edge. We trust Zuck. Obviously, we reserve the right to change our mind. But at this point, not too many concerns with Zuck, although we'll be watching how he approaches it. That's the ugly. I'd say this as well. Apple, interesting events there. Tim Cook retiring, John Turnus taking over, who was the head of hardware. So it'll be interesting. I mean, Tim Cook, look, I'd go into business with him all day. Phenomenal CEO. He gets thrown under the bus a lot, as anybody does that you follow a legend. But John Turnus taking over in September, so we will obviously be watching John Turnus as well.
Market doesn't seem worried about it.
You what? What's that?
Investors don't seem worried about it.
No, they don't. In fact, I think there's some optimism there.
Yeah.
And in this last conference call, they talked about some things coming up, right? Big things coming up, and I don't know what that means, but some optimism for sure. Yep. Tim Cook, Brian, you were saying?
Yeah, just Tim Cook's he's a diplomat. I mean, he can get along with everybody, and that's been very helpful. I mean, he's been able to, he's willing to talk to anybody, and I think that's been helpful for Apple and Apple shareholders and owners of Apple. Yeah, I hope Turnus has learned from Tim.
Yeah. Yeah, you hope. He's the master at that. Tim. Yep.
Yeah.
All right, my friends. Let's move on. Good discussion to what we call the big takeaway. And here's what the big takeaway is about today. It's called diversification. And I want to set this up. I had this conversation probably 3 times this week as we've talked to different people. And that is, we're going to open the kimono of the wealth management / advisor world to everybody. And we're going to break it down. And this is our belief. Mike, you've been in it. You've seen it. I know you agree with this as well. But if you break down our industry, okay, I would say 10% of the wealth managers / advisors out there are just crooks. You don't want anything to do with them, right? Like, stay away from them. Then you've got this huge segment of 80%, which are all the same. Relationships are different, and relationships are obviously important. So that's important, but they're good. Like, that 80% is good. And we'll explain more about what is good and what is best here in a minute. But then you've got 10%. So you got the other 10% of the advisors out there, wealth managers, that actually add value in how they manage portfolios. Okay. And so let's talk about that 80% for a minute. And Mike, this goes back to our days back at 20, 25 years ago or whatever, when we used to talk top-down analysis, right? And this is how they manage money. It's top-down. They look at the globe. And Brian, I know you love this. They look at the globe and they say, okay, I've got to have 45% allocation to the US. And I've got to have 35% allocation to developed countries, non-US. And then I need to sprinkle in a little bit of emerging markets with the rest. And then, you know what we need to do, Mike? We need to go, I need some European financials. And I need some Bangladeshian financials. And so let's do an allocation to those areas. And in fact, I'm super bullish on European industrial companies. And so I'm going to overweight them, and I'm going to add maybe an extra percent to my portfolio. Am I missing anything with that top-down analysis?
No, no. And I think it connects well with the concept of diversification. But something you did say there was, maybe you tweak, what you invest in based on where you think, the money is really going to be flowing for the next year. European industrials, for example. When I think of top down, I think of my sprinkler system, believe it or not, but how you can turn on the valves and send water to the different zones, shut it off in different areas.
Yeah.
Top down in my mind is kind of, you think the water is going to go to the zone in the backyard, so you invest heavily in that quadrant of the backyard, right, where you think the water is going to be on.
Yep.
And then you shut it off kind of elsewhere. A diversified, portfolio in my mind is one where you got a little bit on all the zones in your sprinkling system. You're not just going to where the water's currently flowing. But, that diversification, if it's too broad, you can run into the problem of just not being able to outperform the standard index.
And that's so you end up, what do you end up with a portfolio like that? You end up with thousands of companies that you own via ETFs or mutual funds, and subpar performance. And I say subpar. Look, it's good, right? It's going to grow your portfolio. It's S&P or MSCI All World Country Index. It tracks those, and you're just kind of doing whatever the market does, which isn't bad. I mean, this year the S&P's up 14%. Right. Or not this year. It's up 5% this year. So not
NASDAQ up 9%.
Yeah,
that still is blowing my mind. Yeah.
That's 80% of the industry. Brian, anything to add to that? Thousands of companies in a portfolio. Yippee! I own Bangladesh.
I think every investor sort of goes through this thought, process, and that's where I mean, 30, actually closer to 40 years ago, when I was not quite 40 years ago, but over 35 years ago, just starting in the industry. That's where I started out. I mean, that was the narrative back then as far as how to invest. You sprinkle in, different countries and investment assets, and you just have a little bit of this and a little bit of that, and that's a good way to diversify and protect yourself from bad performance. You also limit yourself as far as having really good or outstanding performance as well. So
yep. That's 80% of the industry, and it's what's taught. It's what academia teaches. Now, I'm going to briefly mention our approach, but I don't want to spend too much time on it. We have before. We've talked about our 4 criteria. We are bottom-up investors. We are agnostic as to where they are in the world. We're just buying the best businesses in the world at good prices, right? People should realize that if they've invested with us or have listened to this podcast. But what I want to do in honor of, it's Berkshire Weekend.
Yes.
It's right. The annual event. And so I've got to we bring up Charlie Munger every week, by the way. The late, great Charlie Munger. I want to just play quickly 2 clips one from Charlie Munger, one from Warren Buffett, where they talk about diversification. And then I want your comments and your thoughts on what they're saying and our approach versus the 80% out there. So we're going to start with Munger and then go to Buffett.
In investing where I have some sort of advantage. And of course, that means I can't do the conventional things. And if I have the advantage in 3 different things, that's enough for any family. 3 wonderful things with the odds in your favor. I mean, do you want egg in your beer in life? And so I think the idea you have to have a big diversified portfolio, that's fine for the ignorant people to be fully diversified. But if you actually know what you're doing, I think 3 investments are plenty. And the Mungers, if you take Berkshire and Costco and Lilu's Asian fund, that's 90% of the money.
Here's Warren Buffett.
Diversification is, we think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses.
All right. What did we hear from the late, great Munger and one of the best investors ever to live, Warren Buffett, about diversification, about that 80%?
I mean, you heard that in Charlie, you only need 3 companies. But we think about risk. I mean, one of the reasons we diversify, or investors diversify, is to reduce risk. And Charlie, his money, 90% of his net worth was in Costco, Berkshire, and then he has a fund that's managed by Lilu. And that's the 3 biggest investments that he owns. And it's interesting. I mean, you look at the risk of the business Costco, or the risk and what we define risk as the probability of a permanent loss of capital. It's very low in Costco. It's very low in Berkshire if you're a long-term investor. And then you add that Lilu on there. That's the actual risk of owning those 3 companies, and that's it, is low. You're not over a long period of time. You're not going to, very unlikely that you'll have a permanent loss of capital. So I think it's great.
Mike, what stood out to you? The way we invest, and then what Munger and Buffett says there.
You know what Brian said, really stuck out. That strikes me. 3 companies, it's so kind of extreme levels of concentration. And I think that's great. And, I would never want to be contrary to Munger and Buffett, but I would say this: for most investors, they don't have the knowledge, the experience, the risk tolerance to do that, right? I think, the negative emotion that can come into it.
Yeah.
I think that can all work against somebody who's trying to, manage their own personal wealth by just buying 3 stocks and never looking back, right? What about the black swan event or something like that could make one of those 3 companies go to zero?
So investors doing it themselves, yes. But what about money managers, that 80%?
Well, and so that's the counterpoint, right? A money manager can defend against that by, just buying the S&P 500, a little bit of everything. But I think the sweet spot is, doing the homework, finding the very best companies that might have a little bit of difference in terms of the business objectives that are going on. Yeah. And that's what we do here, right? We're finding the very best businesses, but they're not all technology companies. In fact, it was interesting when technology had kind of that negative spell, and about a month ago, when the market really started selling off in the middle of the war that had started, paying attention to the portfolio, a lot of those technology companies, they got pretty beat up. But there were a few companies in there that didn't, right? Best companies within their space, but like APD, right? Who'd have thought that there might be a shortage of like urea and helium, right? Yeah. But that sits nicely with a company like APD, and that actually received a nice benefit at the same time. So hopefully I'm not just droning on here, but my point is this: is that concentration makes sense if you want to outperform. It can be difficult as well, especially for somebody who's personally managing their money. But that is the argument for an investment advisor that does focus on buying the very best companies and holding on to those, that does have a little bit of diversification across different sectors and industries.
I was sitting with an individual who is now a client. He runs a private equity fund, and he's done a pretty good job. And we were talking about his current portfolio managed by somebody else, which is that 80%, full of ETFs and thousands of companies. And my response to him was, is there less risk in owning thousands of companies, which you probably know 12 to 15 really, really well of those thousands? Or is there less risk of owning 12 to 15 that you know like the back of your hand? You know them very, very well. Where's more risk? The thousands or that you don't know, or the 12 to 15 to maybe 20 that you know like the back of your hand? And he looked at me and he goes, that's how I manage my private equity fund. I can only keep up with 12 companies. That's all and there's probably only 12 companies worth investing in. And I said, exactly. That's exactly. He's like, okay, send me the paperwork. We'll get, but from a risk perspective, we feel like it's easier to manage risk when you understand the 4 criteria and you buy with a margin of safety at a good price. It's almost, the permanent loss of capital is almost less, Brian.
Yeah, in fact, the math would supports that. Actually, the numbers support that. There was a study done back in the late 60s and also in the late 70s, one by a group called Evans and Archer, and another one called Elton and Gruber. But you have let's say you had it's called non-systematic risk, and that's just, systematic risk is just interest rates go up, inflation goes up, and the market goes down. That's just market volatility. Yeah. Again, we talk about risk as far as the permanent loss of capital, but what we're talking about here is company specific risk. Like a company goes out of business, that's a permanent loss of capital. That's real risk. So if you have one stock portfolio, that company goes out of business, wow, that's very risky. It's permanent loss. But you have 2, you've reduced your risk by approximately 50%. Okay, you have 3, now your risk is down. You're down by almost 75%. Once you get about between 10 and 15 stocks, you've taken out that non-systematic risk. I'm talking about, that's the market volatility, but you've taken out that risk down to like 80, 85, 90%. And so every additional company you go beyond, like say 15 or 16 companies, you're adding just incrementally, just a little bit of reduced, company specific risk, just a little bit. So the numbers support a portfolio of between 10 and 15 or 15 to 20 at the most, a portfolio of those number of companies to really eliminate that company specific risk. You're not really adding, if you own 30 or 40 or 50, you're not reducing risk. You're not reducing the possibility of permanent loss of capital at all. Really, the sweet spot is between 15 and 20 companies, and you've eliminated that company specific risk almost 100%. I mean, it's like 95 or 98%. So the numbers support that. And but the thing that stands out to me with Buffett, he said, if you don't know how to analyze a company, or if you don't know how to value a company, then owning a lot of stocks, owning 500 stocks is perfectly fine. But if you understand how to value a business and analyze a business, then our philosophy is we want to put our money in our best ideas, in our top 10 to 15 or so best ideas. And that makes a lot of sense. And I think the math supports it.
And I love that math. That's why we're under 20 companies, right? Because then at that point you become an index,
right?
And then you become part of the 80%. Tell me this, Meta. We talked about Meta, the bad, right? It fell over earnings. Okay, if somebody doesn't know Meta inside and out, right? Doesn't watch what Zuck eats. I mean, right? The details. How when a stock falls like that, confidence level in staying in goes down to where do you know if you should buy more or you should sell, right? A fund goes down, not knowing it like the back of your hand emotionally creates more risk because you don't know the business.
I mean, we talk about it all the time. If you know your investments, you know the management team, you know the underlying fundamentals of that business. When we have market volatility, when a stock goes down, that creates opportunity. I mean, that we think that creates opportunity. Now, if you don't know that business or you don't trust management, in the case of Zuckerberg, we actually trust him. I mean, and his track record would support that, in my opinion.
Yep.
And so, I'm not overly concerned because Meta was down 8%. Was it yesterday or the day before?
Yesterday.
Yesterday. I'm not. That doesn't concern me because I looked at the report and I'm saying, wow. I mean, revenue accelerated to over 30%. They're getting. I mean, their earnings were incredibly strong. This is a great business. Bottom line, I'm not concerned.
And in the words of Buffett, there are not that many wonderful businesses.
There you go.
Yeah.
Exclamation point.
So why does the 80% do that, right? A couple of reasons. They're taught to do it that way. Academia teaches them that way. And it's a little easier. Like we do things the complicated way here at Iron Gate. We do. Because we feel like it gives our clients an opportunity to get better returns. But the bulk of the industry, hey, let's buy these indexes, let's sit on them, let's allocate based on where our economist says, and then we can go out and find more money, right? That's what they do. So diversification is what it's.
I mean, Buffett said, if you own 50 companies or 100 companies, you just told me. I mean, that just told me there's evidence that you don't
know what you're doing.
Yeah, you don't know how to value business. You don't know how to analyze a business. And he said, there's nothing wrong with that.
It is good.
There's nothing wrong. If you don't know how to do that, then you should be buying an index. 100%.
A wise man said that there's good, there's better, and there's best, right? That's good. We're looking for the best, right? Yeah. And do you remember looking at the 13F of Charlie Munger when he was around?
Oh, yeah.
Oh my gosh, the stones on that brother. Holy cow.
Yeah.
5 companies, 3 companies. Like,
well, yeah. I mean, he said 90% of his net worth is in Costco, Berkshire, and Lee Lu. I mean, that's it.
Pretty incredible. That, my friends, is the big takeaway for the day, for the week, for the podcast, whatever it is. All right, my friends, any final words as we wrap it up for today?
It's been good. Thanks.
All right, man. Okay, Mike, anything?
It's a fun week. It's fun watching those businesses evolve, which they're doing.
Yeah. Right now. It's a good way to put it. A fun week. Man, we love what we do. It's fun. Like, we're geeks and we love it. We have a lot of fun doing it. So thanks if you're a client of Iron Gate. Thanks for trusting us to manage your money. Brothers, we will see you. It's Friday, so we'll see you next week.
Yeah.
Until next time, folks. Bye now.
Bye.
Bye.